All right. What's good, people? I'm Winston. Welcome to part two of the stock market fundamentals course. Today, and we are going to discuss technical analysis. Before we get started, here's a little bit about myself. You've been in part one, so you should know this already. My name is Winston. I'm from Houston, Texas. I traveled to over 14 different countries. I'm a United States Navy veteran. Yes, I served my country. Best worst decision I ever made in my life. I'm a National University graduate. I graduated last year, so 2019. And I've been trading stocks, trading options since 2019, but started trading stocks in 2017. And I'm an entrepreneur. I'm out here working for myself. That's what I want to do. I'm not a financial advisor. And by watching and being a part of this course, you understand that there's significant risk in trading on the stock market. And you are the only party that can be held liable for any gains or losses that you take in this market. This course is for educational purposes only. Remember that. Do not invest the last of your money into the stock market. If all you have left is your rent money, go pay your rent. Do not spend your last $2 in the stock market if that's all you have. Keep one for the bus fare, one for the jukebox. Do not expect to get rich overnight. Even though it can happen, there's a probability of it happening. Don't expect it because no one knows what this market can and will truly do. All we can do is react. And you can do some planning, right? The stock market is a way to grow your assets and change your life, right? The bank only gives you 1 or 3% interest. The stock market, on average, historically, has given more than 10% per year. Reason one why I choose the stock market over the bank any day. All right, keep these in mind. Start small. Research before investing your funds, right? Have a personal investment goal, have patience, and have fun. If you follow these steps, trading will get easier and easier and easier and easier. Trust me. So, things we're going to discuss: technical analysis. We're going to break this down little by little. All right. So, technical analysis focuses on the idea that the market follows patterns and trends. By watching price points, the hope is to be able to recognize those patterns, right? So here are 3 things that I like to focus on, or that traders like to focus on when it comes to technical analysis. We focus on market trends, we focus on candlestick patterns, and we focus on support and resistance. You use these 3 things to read charts, right? I'm going to break them down for you. So market trend refers to the direction in which the market is moving. It can only move in 3 ways, people. It can move up, it can move down, and it can move sideways, right? So an uptrend, price is going up. A downtrend, price is going down. Sideways, price is consolidating, waiting for a move. This is an example of an uptrend, right? So during an uptrend, the market creates higher highs and higher lows. So what that means is you see this movement up. This is an uptrend on a chart. Here we have a high, we have a low. Here we have a higher high, a higher low, because this low is higher than that low. That high is higher than the previous high. Here's another high, another low, another high, another low. So you see we're repeating the pattern. Higher highs, higher lows. This confirms that we're in an uptrend. As you can imagine, the downtrend is the exact opposite. The market creates lower lows, lower highs, and lower lows. So high, low, high, low, high, low, high, low, high, low. I'm about to make a song out of that, but you should get the point now. When the market is moving sideways, right, there's no real significant change in price point. This is considered consolidation. So sideways action is what you see right here in this area, right? As you can see, price action is trading within this same range, right? Not creating higher highs and not creating too many lower lows, just trading in the same range. This is sideways action or consolidation, sideways movement. So, uptrend, downtrend, or sideways movement? You tell me. Okay. Uptrend, downtrend, sideways movement. You tell me. Okay. Uptrend, downtrend, or sideways movement. You tell me. Okay. This should have beat in the point. When you're trading, when you're looking at charts, always identify the trend. Are we in an uptrend? Are we in a downtrend? Or are we consolidating, moving sideways? Identify the trend will help you as a trader. All right. So by identifying the trend, right, it helps you predict price movement, determine entries and exits, and analyze stock strength, and you gain the ability to beat the competitors. You never want to trade against the trend. The trend is your friend. If the stock market is moving up, you want to be in trades that are moving with the market. That way you can be more profitable. That's the point of following the trends, right? So do some work on that on your own. Pull up a chart, practice finding the trends. Next part of technical analysis, we have candlesticks. And I've recently learned a new strategy with candlesticks, but the old candlestick patterns that I first started studying, some of them are still relevant. And I suggest people start with the old patterns just to gain some reference, right? So candlestick patterns refer to charts units that represent the price point of a stock. So candlesticks give data about a stock's open, close, high, and low price points during a specific time. As a trader, we can use candlesticks patterns to confirm trends and observe stock price. So I know that was a mouthful. We're gonna break this down for you. So there are two types of candles that traders use. There's actually more, but I want you to understand the basics of a bullish candlestick and a bearish candlestick, right? So on a bullish candlestick, right, you have the body, which is the complete filled in green space, right? And then you have what are called wicks, these little points at the end. These are your wicks. So when you see a green candlestick, you know the top of the body, this line area right here where this arrow is pointing to, this represents the point where price action closed. The price where price action closed. The bottom of the body of this candlestick, basically where this arrow is pointing, represents the open. All right. The low point, the bottom of the wick, this little point right here with the arrow, this represents the low. This is the lowest that price went during this time frame or during this candlestick. And obviously, the tallest point of the wick represents the highest point price reached during this candlestick or time frame. So basically, if you were trading on like the 5 minute, right, price action opened here, right, open, came down, bounced, created a new high, and before the 5 minute time frame was over, price action came down and closed in this area, right? The exact opposite, well, at least the opening and close are opposite with bearish candlesticks, right? You still have the body, you still have the wicks. The top of the wick still represents the high. The bottom of the wick still represents the low, but the open and closed are flipped, right? So with bearish candlesticks, red candlesticks, right? The top of the body represents where price action opened, and the bottom of the candlestick represents where price action closed, all right? Pretty self-explanatory. So when you see these candlesticks, right, remember this. This tells you where they open, where they close, where the highs and where the lows were, right? You can use candlesticks to gauge where, you know, stock could potentially go, right? Where stock price could potentially go. So when you see bullish candlesticks that are green, this means price is increasing. When you see bearish candlesticks, red candlesticks, this means price action is decreasing. Practice this on your own. Practice being able to read these candlesticks on your own. It's going to make you a better trader. Now let's get into candlestick patterns, right? There are single patterns, there are double patterns, and there are triple patterns, right? And you can use these patterns to make trades in the stock market. So this is how it goes. With these candlesticks, right? Candlesticks can be broken down into different families, right? So you have the hammer family. Basically, your candles look like hammers, right? So you have upright hammer, upright hammer, inverted hammer, and they can be red or green. And the hammer, basically the hammer part, the body could be at the top, the bottom, or the middle, right? You have doji candlesticks, and these look like T's or plus signs. Normally dojis mean that neither, well, we'll get into that. And then you have bearish and bullish marabuzus, or just think about them as full candlesticks, right? The bodies are longer, the wicks are smaller, right? So these are full candlesticks. We're gonna break some of these down so you can get familiar with it. So these are your doji candlesticks, right? Each one has a different name. Each one represents something different, right? So you have a long leg doji, a doji star, a full price doji, a gravestone doji, and a dragonfly doji, excuse me. Doji candlesticks show that stock price has closed at the same price it opened. So what that means is that means neither bulls or bears could take control of the stock, right? But later on, as just give me 1 second, 1 second. All right, cool. So again, dojis usually mean that neither bulls nor bears could take control of a stock, right? That's important to remember when trading. All right, so then you have double candlestick patterns. All right, these are some examples of double candlestick patterns. You have a bullish engulfing, where the second candle is green and it completely takes out the high and the low of the previous candle. The opposite of a bullish engulfing is a bearish engulfing, where the second candle is red and it completely knocks out the highs and the lows of the previous candle. So if you look, the wicks are completely outside or above the previous high and below the previous low. All right. Two more patterns are the bullish harame, where basically the second candle is green, but it's inside of the highs and the lows are completely inside of the previous candle. And then you have the bearish harame, where the second candle is red and it's completely inside of the previous candlestick, right? So as you're looking up these chart patterns, as you're getting more familiar with these chart patterns, and you understand how to read the open and the close, these small things make you a better trader. I know y'all just popping in, and we're just gonna keep going from here. And this video will be recorded and placed on YouTube later for you to rewatch and gain some understanding. And we're more than halfway through. So let's break down the bullish engulfing, right? The bullish engulfing pattern appears normally during bearish trends. So you see bullish engulfings usually during a downtrend. So after price action has fallen for some time, right? In this pattern, a bearish candle is followed by a much larger bullish candle. So normally when you see a bullish engulfing candle, basically this green candle, where it completely takes out the highs and the lows of the previous candle, this could be an early sign of a reversal in the trend. Basically saying that if you see a bullish engulfing at the end of a downtrend, this could be an early sign that price is going to reverse back to the upside, right? That's one way to use the bullish engulfing, right? Moving forward. So aside from single candlestick patterns and double stick candlestick patterns, there are also triple candlestick patterns. These are two examples. We have a morning star and an evening star. Once we get into day 4, I'm going to introduce you guys to a strategy I've been using for the last several months by a guy named Rob Smith, and we learned different names for these patterns, but still important to know. Let's break these down. Or with the morning star, right? The morning star pattern happens during a bearish trend. So basically it happens at the end of a downtrend after price has fallen for some time, right? It starts with a bearish candle. So we have this red candle here. It's followed by a small bearish or bullish candle, right? So this candle in the middle could be red or green, but notice how it's smaller and different from this one. And it ends with a third bullish candle, right? So the third candle, the last candle, as you can see, it took price action back up, right? It normally signals an uptrend, like I said earlier. When you see these 3 candlesticks, this morning star at the end, at the bottom of a downtrend, it's usually an early sign that price can reverse back to the upside, right? So we use all of these patterns to gauge what's going on with price action with that particular stock, right? We don't guess, we don't assume, we wait for price action to tell us what's going to happen, right? So if you pay attention and you learn more about these stock patterns, you go review stock patterns, right? It helps you predict price movement, determine better entries and exits, analyze stock price, and you gain the ability to beat the competitor. This is the second time this has been showed in this presentation, because I want you to know that even the simplest of information, like being able to read a candlestick, being able to notice stock patterns, learning more stock patterns makes you a better trader, puts you in a better position to make better trades, which makes more money for you. Next, we have support and resistance, right? Support and resistance are base trading indicators. That means these are ones that everybody uses, right? They can be extremely helpful in your trading strategy, right? And you use support and resistance to determine where stock's current price will reverse, continue, or pause. So I like to think about support and resistance like bumpers when you go bowling, especially if you trash. If you trash, you use bumpers, right? Because you can't stop the ball from going, you can't stop from getting a gutter ball. When you have those bumpers, right, the ball will bounce in between those bumpers, to try to correct the ball's action and allow you to hit those pins, right? Sometimes when you go bowling and you hit those bumpers too many times, those bumpers will fall, causing the ball to go into the gutter, right? It's the same thing with support and resistance. And we're going to get into it a little bit, right? So support defines the price level that prevents the price of a stock from falling lower. So basically, well, I'll keep reading. The idea is that as stock price decreases, buyers will come in and prevent the stock from continuing downward. Now, this is something that I learned along the way, but it's not always true, right? Because support can often become a level of resistance. So what that means is, just because you have a level where buyers have stepped in before and bought the stock back up and sent it back into an uptrend, that doesn't mean that will always happen. That just means you found the area where traders or buyers usually step in, right? And the reason why support can become resistance is because if the support fails, right, price action falls through that support. When price action reverses and tries to come back up, it now has to bounce past that support. Well, it'll be a resistance at that point, you know, to create a new high, right? And we'll get into that. I'm gonna pull up some examples. So this is a simple example of support, right? Support is found by drawing a line at multiple points on a chart or price reversed to the upside. So as you can see here, right? Price action was continuing up. It reached a certain point, reversed back down, came back to a previous level, reversed back up, right? Then reversed back down to that same previous area where it bounced before, and then price action continued up. So price action hit this level multiple times, right? Hit this red line level multiple times. So we know that this qualifies as a point of support because price action could never break through it. It only bounced off of it. Resistance is the exact opposite of support, right? Resistance defines the price level that prevents the price of a stock from raising higher. The idea is that as the stock price increases, sellers will come in to prevent the stock from continuing upward. Now, just like with support, resistance can become a level of support, meaning if the stock at one point had a hard time crossing above a certain level, but once it got above, right, creating a new high, it reversed, came back down to what was once resistance, and then reversed back up to the upside, making that previous resistance point a point of support. We're going to get into it a little bit, right? So here we have here. Oh man, this should say resistance. So resistance is found by drawing a line at multiple points where price action reversed to the upside. I need to go change it. So follow the lines here. Price action came up to a point, bounced down, creating another low. Came up to that same point again, bounced down, creating another low. So automatically, we know that this point, this red line, is a point of resistance because price action couldn't get above it. Now, once price action actually broke through this resistance, let's say it came back down to it and then bounced, that'll make this point of resistance a point of support now, because this is an area where buyers don't want price action to fall below, right? So it gets bought back up. All right, so here's an example. So traders typically buy a support and sell a resistance. So let's say you were trading Sony, and Sony was $50 at a time, and it fell down to a support of $47. This is typically where traders like to buy. They like to buy at points of support. Sony, as it moved or continued through the day, came up to a point of $62 and reversed, right? And fell right back down to a point to $60. It got to $60 and reversed back up, creating a new high, right? Going back up to 62. So we learned two things. We learned 62 has been a point of resistance, and we learned that 60 is a current level of support, right? So you can do one or two things here as a trader, right? You could wait for price action to reverse up to that 62 and sell, or you can hold, giving the stock price more time, right, to carry out. But you got in all the way at 47. So you're still up regardless, right? So let's keep going. Price action hit that $60, right? Bounced up to the 62 level of resistance and fell again. So once it failed for the second time, as a trader, you can sell, right? And you're still in the money because you bought at 47. But if you would have waited, right, price action came down to that strong level of support at $60, right? And it bounced, coming up, hitting that level of resistance at 62 a third time and finally breaks. Remember what I was saying about that bumpers? You hit a level too many times, it becomes weaker, right? And then finally breaking 62, creating new highs. So just by setting your levels of support and resistance, right, and watching how many times price action fails at those levels or gain support at those levels, you can gain profit, right? You can be a more profitable trader just by measuring and using things that you learn, such as support and resistance, right? This is why I love the fundamentals. Every week I'll review my fundamentals, candlestick patterns, support and resistance, and time frame analysis, which is not in this one, but we'll get into that later. I keep the fundamentals in my mind at all times, and I use them at all times. They're extremely important, right? So that completes the basic training. And we're gonna go over some examples for you guys so you can get an understanding. So let's see. So right now I have Snapchat pulled up, and I'm gonna pull it up for the day. We're on the daily chart right now. So if I'm looking, whenever I'm looking for support and resistance, I always like to start with the lowest level of support and then look for the highest level of resistance. All right. So when you're looking for the lowest level of support, just look backwards and see where price action fail and bounce multiple times. So if I'm looking backwards, I can see price action fail and bounce multiple times around this area, around this 47.94 level. So it's trying to do stupid on me. All right. So I mark it. Let me edit this properties real quick. Arrow type. Where is it? Where is it? Where is it? Edit properties. You know what? Setting. Here we go. Apply. Boom. All right, let's see if it does right now. Remove drawing. All right, boom. So this 47.94. We know this is a lower level of support. And we have proof, right? We see price action fail to the support, bounce, create a new high. Fail to the support again, bounce. Fail to the support for the third time, bounce, creating a new high. And if we look forward, right, we see that price action has bounced almost every time it's come back towards this level. So we know this is a primary level of support. This platform is called Thinkorswim through TD Ameritrade. So now that we have support, right, let's look for resistance. Notice how my support is green. I like changing the colors of each to know. So if we're looking for resistance, the highest point of resistance, right, we want to look at level where price action has reversed multiple times. And if you can see, I would say right here is a level of resistance. Edit. Change this red so I know it's resistance. And now we have a point of resistance, our primary point of resistance, right? You see price action touched it, failed, touched it, failed, touched it, crossed above it, failed, right? And so now it acted as a point of support, but it fell through that support, right? And then price action came back up and touched that support. And as you can see, couldn't get above it. So now we know that support is resistance. It's resistance, right? Price action failed. And once it failed, dropped off the face of the earth and went all the way back down to our primary point of support down below 48. So if you can find support and resistance, you can find the range at which this stock or whatever stock trades in, right? And that's why it's good to find these. So aside from finding your primary, right, I always like to find, you make money either way. Exactly. You can make money at the top when it falls. You can make money at the bottom when it bounces, right? So aside from finding your primary, it's always good to find a secondary as well. I love finding secondary points as well. So let's look for those. A second point where price bounce. I want to say, if I'm looking at this, I'm going to say it right around here. Yeah, I like that, right? So if we look here, right, we have our second level of support. Price action came down to the support, bounced, boom. Came down again, broke it a little bit, bounced, boom. Same here, bounce. This is current, this is more current, right? It hit support, bounce, right? But as you can see, it hit it several times and it fell through it. Tried to get back above it, and now the support is acting as resistance. Same here. Tried to get back above it, but now these support levels are acting as resistance. So we're seeing the range in which this stock trades, right? But we're also seeing support become resistance and resistance becoming support, right? So this just gives you ranges and levels to trade by, right? This is not saying this is necessarily a great point of entry or a great point of exit. This is just giving you an idea, which is all you need when trading. All you need is an idea and a trigger. But before we move forward, let's look for our second point of resistance. I'm gonna just duplicate this. Second point of resistance is really not that low, but yeah, I like this level. I like this level a lot, right? So reason why I marked this as my second level of resistance for a few reasons, right? Well, primarily, if we look here, right, the first time Snapchat hit highs, it hit highs at this level, at this $70 level, and then rejected, right? And then if you look forward, you see that price action consolidated for a little while between our two levels of resistance, right? Hit the top, fell, consolidated, hit the top, fell, consolidated. Then it just fell all the way through it. I think this was the vid that made this fall like this. Well, no, that'll be more like here. I have to go look this up. 1025. I have to look this up, find out what made it fall like this, right? But you see how we just use these as ranges. We use these as ranges. So now that you know how to find them, you have to practice them. Pull up a chart, practice them as often as you can. I have 2 here, always find 3. Look for your 3 points of support, 3 points of resistance. You find support and resistance by marking level where price bounced or reversed multiple times. I think it's, yeah, this is think or swim. This is think or swim. You want to use these, right? The fundamentals aren't going anywhere, regardless of what anybody has to say about them, regardless of how anybody trades or what trading pattern, trading strategy that they use. Support and resistance will always be relevant, to me at least, will always be relevant. And anybody who trades in my group, you're going to get used to seeing support and resistance, because I talk about it whenever I use my watch list. I'll say, I might not have it drawn, but I'll say SPY has a support at 450, another one at 436. It's crazy. I remember that off the top of my head, right? You want to use these again and again and again in your trading. Now, I want you to see, we talked about a morning star pattern, right? That was one of the patterns that we talked about. Let me pull up my whatchamacallit again. So I want to get into these patterns a little bit. Cat patterns. All right, so where were we? Boom. So the morning star pattern happens typically or normally during a bearish trend, right? It starts with a bearish candle, has a small green or red candle in the middle, and ends with a bullish green candle. right? It normally signals an uptrend. Well, let's see how true that is. How do we identify a downtrend? Higher highs and higher lows, right? So I'm gonna do this here, and I'm gonna draw for my low here, right? Let's see. We have a higher high because we created a high here. We have a low here. We have a lower high here, so a lower high, and then we have a lower low here. So we're clearly in the downtrend at this point, right? We have a red candle, a small red candle, and then a green candle. Tell me you don't see that morning star right there. What happened after that morning star? I need to see it in the chat. What happened after that morning star? Pew, pew, to the skies. To the skies. That's where Snapchat went. Snapchat went from, what is it, 62.41 to 79, and this is the daily chart. 1, 2, 3 days. Could you imagine if you would have caught that just because you paid attention to the downtrend, the morning star pattern? Could you imagine? Could you imagine? Beautiful, beautiful. The fundamentals aren't going anywhere. I don't care what nobody says. The fundamentals aren't going anywhere. Identify the trend. Identify a pattern that signifies a reversal. Mark your levels of support and resistance. Boom. Look at the support and resistance. Look at the resistance. This was our primary level of resistance, and we found this looking backwards, and price action hit it beautifully. I don't care what nobody said. The fundamentals aren't going anywhere. You can pull up any chart and look this stuff up over and over and over again. I see another example of a morning star already. I'm gonna mark it again. Downtrend. Actually, put this right here. Right? High, low. I guess you can call this a high, low. We're clearly in the downtrend, right? Price action is moving down. Red candle, small red or green candle, followed by a large, full-bodied green candle. What happened next? Boom, to the moon at that same level of support that we had marked. So from $52 all the way to $63. That's over a $10 gain in 1, 2, 3, 4, 5, 6 days and over a week. What? Stop playing with me. These fundamentals not going anywhere. I don't care what strategy somebody use. These fundamentals aren't going anywhere. You can trade the same setup over and over and over and over and over again. I just proved it to you because I found the same setup twice. This is factual. This is true. This stuff works. All it is patience and finding your setup, finding the setup that works for you. You could never trade another stock pattern again if you wanted to, if you didn't want to. If you didn't have this downtrend, this morning star, you never have to trade another pattern if this is the one you like. You just have to find the one that works for you. Find the strategy that works for you, and you will make money in this stock market, yo. This is how I'm making $100 a day. I'm not making $10,000, $20,000. Will it be my goal one day? Sure. I got a million side hustles right now, so all I need is $100 from each one, and I'm happy. I can make $300, $400, $500 a day. I know how. I can make more with this stock market. I know how. But I stick to my trading plan. I stick to the way I trade. I stick to the way that I like to trade because it makes me money. And you have to do the same thing. So I'm going to stop recording right now. That concludes my fundamentals course. And I want to open it up for questions if you all have questions.